pull up a chair. Get comfortable. Today, we're going to talk about something foundational. Something that cuts through all the noise, all the talking heads on television yelling about the next hot stock, all the confusing charts and crypto, jargon that makes your head spin. We're going to go back in time, back to 1956. Eisenhower's in the White House. Elvis is on the Ed Sullivan Show, and a young fella, just 25 years old, is about to change the world of investing forever. Now, before we get into the meat of it, let me ask you something. What if I told you that this young man, who would go on to become the most successful investor in human history, once said, and I'm quoting him directly here, "I think I could make you 50% a year on $1 million. No, I know I could. I guarantee that. 50% a year. Guaranteed." That sounds absolutely insane, doesn't it? Especially coming from a man who is now famous for his slow, steady, conservative approach. But he said it. And the thing is, he meant it. That promise, that incredible, almost unbelievable promise, is the hook for our entire conversation today. Because that 50% year version of Warren Buffett, the young, hungry, brilliant operator working with what he called peanuts, that's the version that laid down the rules for everything that followed. These aren't just tips or tricks. These are the bedrock, iron-clad, non-negotiable ground rules he forced every single one of his early partners to agree to before he would touch a single dollar of their money. And by the end of our time here today, you'll understand them. And more importantly, you'll know how to apply them to your own portfolio right now in today's crazy market. So stick around. The secret to that 50% guarantee is baked right into these rules. All right, let's set the scene. It's Omaha, Nebraska, 1956. Warren Buffett has just come home from New York City, where he was working side by side with his hero, the father of value investing himself, the great Benjamin Graham. Now, Graham's getting ready to retire, and he offers his star pupil a piece of the legendary Graham-Newman partnership. It's the opportunity of a lifetime. And what does this 25-year-old kid do? He says, "No, thank you." He turns it down flat. He decides to pack his bags and go home. Now, when he gets back to Omaha, he doesn't have a grand plan. He figures he'll read a lot, maybe take a few classes. He was already so confident in the power of compound interest that he basically considered himself retired. But then, a funny thing happened. A few family members, an old college roommate, his lawyer, 7 people in total, they come to him and say, "Warren, you know about this stuff. Tell us what to do with our money." Buffett, having had a bad experience selling stocks for his father's brokerage, says he'll never do that again. But then he gets an idea. He says, "I'll tell you what, I'll set up a little partnership, just like my mentor Ben Graham had. You can put your money in with mine, and I'll manage it all together. They all agreed. But before he'd take a single check, he did something that tells you everything you need to know about his character. He invited all 7 of them to dinner at the Omaha Club, and when the bill came, everyone paid for their own meal. He made them go Dutch. A chuckle softly. That night, he handed each of them a few pages. It wasn't the legal partnership agreement he wanted to talk about. He told them not to worry about that too much. No, he handed them a short, carbon-copied list of precepts. He called them his ground rules. He looked these people, his friends, his family, square in the eye and said, This is the philosophy. This is all that matters." He went through each point, one by one. He insisted on having complete control. He told them he wasn't going to call them up to chat about his latest stock pick. He wasn't going to give them daily updates. He was going to operate in silence. And then he said the most important line of all. "If you are in tune with me, then let's go. If you aren't, I understand. No sales pitch, no promises of riches. Just a set of rules. A philosophy." Everyone in that room signed on. And for the next 13 years, as his little partnership grew, every single new partner, big or small, got the same treatment. A copy of the ground rules and a careful, deliberate explanation of what they meant. Over that time, he never had a losing year. He compounded his partner's money at nearly 24% a year after his fees. He absolutely crushed the Dow Jones Industrial Average. He built the foundation for what would become Berkshire Hathaway. And it all started with these simple, powerful rules. So today, we're going to be a fly on the wall at that dinner at the Omaha Club. We're going to go through these rules, one by one, and unpack the timeless wisdom they hold. This is part 1. Let's dig in. Ground rule number 1. In no sense is any rate of return guaranteed to partners. Partners who withdraw 0.5% monthly are doing just that, withdrawing. If we earn more than 6% per annum over a period of years, the withdrawals will be covered by earnings and the principal will increase. If we don't earn 6%, the monthly payments are partially or wholly a return of capital. All right, let's translate that from 1950s legalese. What Buffett is saying here is crystal clear. There are no guarantees in this business. Think about how radical that is. He starts his pitch by telling you that you could lose money. He's managing expectations right from the get-go. He had a deal where partners could pull out a little bit of cash each month, sort of like a dividend. And he's making it painfully obvious that if his investments don't earn at least 6% a year, those payments you're taking are just your own money coming back to you. You're eating your own seed corn. This is the absolute opposite of Wall Street today, isn't it? Today, everyone wants to promise you the moon. Guaranteed returns. Can't miss crypto. This stock is going to the moon. It's all hype. It's all designed to get you excited, to get you to hand over your money based on emotion. Buffett did the opposite. He wanted his partners to be stone cold realists. He was building a partnership of business owners, not a casino for gamblers. This rule forced them to understand the nature of investing. It's not a savings account. It's not a paycheck. It's ownership in businesses. And businesses have good years and bad years. Think about it in your own portfolio. When you see a stock in your account that pays a nice, juicy dividend, do you ever stop to think about where that money is coming from? If the company is growing and profitable, that dividend is a wonderful thing. It's your share of the earnings. But if the company is struggling, if it's borrowing money just to pay that dividend to keep shareholders happy, well, that's not a return on your capital. That's a return of your capital. And there's a world of difference between the two. Buffett wanted his partners to have a long-term mindset. He established a benchmark, a 6% hurdle rate, and said, over the long haul, this is the goal. But some years we'll clear it by a mile, and some years we might fall short. Don't get distracted by the short term. It's a lesson that is more important today than it ever has been. I'd be curious to hear from you all in the comments. Have you ever bought into something because of a promised return, only to be disappointed? What was the lesson you learned from that experience? Let us all learn from each other down below. Ground rule number 2. Any year in which we fail to achieve at least a plus 6% performance will be followed by a year when partners receiving monthly payments will find those payments lowered. This one is a direct consequence of the first rule, but it's about accountability. It's another splash of cold water in the face of anyone looking for a free lunch. What he's saying is, folks, this is a real business. If we have a bad year, we have to tighten our belts. We can't just pretend it didn't happen. Again, compare that to the world today. We have companies that lose billions of dollars, yet the CEO still gets a massive bonus. We have funds that underperform for years, but they keep charging the same high fees. There's a disconnect from reality. Buffett was tying the partnership's cash flow directly to its performance. This wasn't just a rule for his partners. It was a rule for himself. It forced him to be disciplined. He couldn't afford to have a truly terrible year, because it would directly impact the income of the people who trusted him. This rule is all about acknowledging reality. It's about understanding that investing isn't a smooth, upward sloping line. There are bumps. There are valleys. And a smart investor, a true business owner, prepares for those valleys. They don't live on the assumption that every year will be a record year. You can apply this to your own life. When you're planning for retirement, are you using a realistic rate of return? Or are you plugging in 12% a year, every year, into that calculator because it gives you a big, happy number? A bad year in the market can have a real impact on your plans if you're not prepared for it. This rule is a reminder to be conservative, to be realistic, and to build a margin of safety, not just into your investments, but into your financial life. It's the difference between being a fragile speculator and a resilient antifragile owner. Ground rule number 3. Whenever we talk of yearly gains or losses, we are talking about market values. This may bear very little relationship to the realized results for tax purposes in a given year. Okay, on the surface this sounds like some dry, technical accounting talk. But I promise you, there's a piece of profound wisdom buried in here. What Buffett is doing is separating the idea of business performance from tax maneuvering. He's telling his partners, the only thing that matters is how much our ownership stakes are truly worth at the end of the year compared to the beginning. That's our scorecard. Don't get confused by what the tax man sees. Why is this so important? Because many investors make terrible decisions just to save a little bit on taxes. They'll sell a winning stock too early to avoid a long-term capital gain, or they'll hold onto a losing stock forever, telling themselves, well, at least I can use it as a tax write-off someday. This is what's known as the tail wagging the dog. You're letting a secondary concern, taxes, dictate your primary mission, which is to grow your capital by owning wonderful businesses. Buffett wanted to be free to operate as a rational business owner. If a stock he owned was still cheap, he wanted to hold it even if he had a big unrealized gain. He wasn't going to sell a dollar bill for 80 cents just to give Uncle Sam 15 cents. Conversely, if he made a mistake and a business wasn't as good as he thought, he would sell it and take the loss without worrying about the tax implications. His focus was always on the underlying value of the business. That was the North Star. The annual report card was based on the change in that intrinsic value, as best estimated by market prices at the end of the year. Taxes were just a mechanical detail to be handled later. This is a powerful mental model for all of us. When you look at your portfolio, do you see a collection of businesses? Or do you see a collection of tax lots? Are you making buy and sell decisions based on the future prospects of the company? Or are you trying to outsmart the IRS? Buffett's success is a testament to the power of focusing on what truly matters, the value of the business. Everything else is just noise. Ground rule number 4. Whether we do a good job or a poor job is not to be measured by whether we are plus or minus for the year. It is instead to be measured against the general experience in securities, as measured by the Dow Jones Industrial Average. If our record is better than that of these yardsticks, we consider it a good year whether we are plus or minus. If we do poorer, we deserve the tomatoes. Now this rule right here is the heart of the whole operation. This is the one that separates the true professionals from the amateurs. He's saying, look, I can't control the weather, I can't control whether the whole market goes up or down. The tide is going to come in, and the tide is going to go out. Don't praise me if we make 20% in a year when the market goes up 30%. In that year, we failed. And don't you dare criticize me if we lose 10% in a year the market goes down 30%. In that year, we were heroes. This is the concept of relative return versus absolute return, and it is everything. The average investor, the amateur, is obsessed with absolute return. They log into their account, see green, and they're happy. They see red, and they're terrified. Their emotions are completely tied to the random, manic, depressive swings of the overall market. Buffett is teaching his partners to think like professionals. A professional knows that their job isn't to predict the market. Their job is to make better decisions than the average person within that market. His benchmark, his competitor, was the Dow Jones Industrial Average. That was the par for the course. His entire goal was to beat par over time. He used a wonderful analogy. He said, think of a duck sitting on a pond. When the water level of the pond rises, the duck rises. When the water level falls, the duck falls. He said the duck can only take credit for his own activities, for flapping his wings. The rise and fall of the pond is hardly something for him to quack about. Most money managers out there are just quacking about the pond. When the market is up, they take the credit. When it's down, they blame the Fed or inflation or a war overseas. Buffett refused to play that game. His only question was, did we flap our wings? Did we, through our own skill and analysis, do better than someone who just bought the whole market and went to sleep? This is the most honest and intellectually rigorous way to measure investment performance. And it's a standard you should apply to yourself. At the end of the year, don't just ask, was I up or down? Ask, how did I do compared to the S&P 500s? If you beat the index, you had a good year, no matter what the absolute number says. If you didn't, then you have to ask yourself if all the time and effort you're spending picking stocks is actually worth it. It's a tough question, but an honest one. And honesty, as Buffett knew, is the bedrock of long-term success. What do you folks think? Is it fair to judge yourself against the market, or is just being in the green good enough? I'd love to see a healthy debate on this one in the comments. Ground rule number 5. While I much prefer a 5-year test, I feel 3 years is an absolute minimum for judging performance. It is a certainty that we will have years when the partnership performance is poorer than the Dow. If any 3-year or longer period produces poor results, we all should start looking around for other places to have our money. This rule builds directly on the last one. If Rule 4 was the how we measure success, this rule is the how long, and it's another masterclass in managing expectations and enforcing discipline. He's telling his partners, straight up, we are going to have bad years. We are going to have years where we underperform the market. I guarantee it. 1 year is just noise. It's statistical randomness. But if I can't beat the market over any 3 to 5 year stretch, you should fire me. And I should fire myself. Think about the incredible confidence and humility in that statement. The confidence to know that his method would work over the long term, and the humility to set a clear, objective standard for his own failure. This is the antidote to the short-term thinking that plagues the investment world. We live in an age of instant gratification. We check our portfolios every day, every hour. We get excited about a stock that's up for the week, and we panic about one that's down. Buffett is telling us that all of that is a complete waste of mental energy. The game isn't won in a day, a week, or a year. It's won over cycles. Why 3 to 5 years? Because that's typically long enough for a full market cycle to play out. It's long enough for a company's true business value to start being reflected in its stock price. It's long enough to separate skill from luck. Anyone can get lucky for a year. A monkey throwing darts at a stock page can have a great year. But to outperform the market over 3, 5, 10 years, that requires a sound process. He also includes a very clever exception. He says the only time you shouldn't judge him for underperforming over a 3-year stretch is during a speculative explosion in a bull market. He knew, even way back then, that his conservative, value-based approach would look boring and outdated during a bubble, while everyone else was buying dot-com stocks with no earnings in 1999. Buffett was sitting on his hands, looking like a fool. He underperformed badly. And then the bubble burst, and his wisdom was revealed. He was playing a different game. He was playing the long game. This rule is a call for patience. Patience with your strategy, and patience with yourself. Don't abandon a sound investment philosophy just because it's out of favor for a year or 2. But also, have the discipline to know when it's not working. Set a reasonable time frame. Measure your results honestly against your benchmark. And if you're consistently failing, have the courage to change course. Ground rule number 6. I am not in the business of predicting general stock market or business fluctuations. If you think I can do this, or think it is essential to an investment program, you should not be in the partnership. This one is short, blunt, and powerful. It might be the most important rule of them all for the modern investor. He is saying, unequivocally, I do not have a crystal ball, and if you're looking for a guru who does, you're in the wrong place. Every single day, we are bombarded with predictions. Pundits on TV telling you where the Dow is going by Christmas. YouTube gurus telling you which crypto will 100x next month. Analysts forecasting interest rates and oil prices and GDP growth. Buffett's position on all of this: it's garbage. It's a fool's errand. He famously said that forecasts tell you a great deal about the forecaster. They tell you nothing about the future. He knew that the short-term direction of the market is based on a million different variables, on the collective emotion of millions of people. It's fundamentally unknowable. His focus wasn't on predicting the rain, it was on building an ark. He didn't care what the market was going to do. He only cared about one thing: buying good businesses at fair prices. His entire philosophy was built on analyzing individual companies, one by one. He concentrated on what should happen, not when it should happen. He said, "The course of the stock market will determine, to a great degree, when we will be right. But the accuracy of our analysis of the company will largely determine whether we will be right." It's a brilliant distinction. The weather is in your control. That's your research, your analysis, your discipline. The when is up to the whims of the market, which is out of your control. So why waste a single second worrying about it? This rule is incredibly liberating. It gives you permission to ignore 99% of the financial news out there. It frees you from the anxiety of trying to guess the next market move. It allows you to focus all your energy on being a business analyst, not a market timer. Find a great company, buy it at a reasonable price, and let the market do what it will. Over the long run, if you were right about the business, you'll be right about the stock. It's as simple and as difficult as that. Ground rule number 7. I cannot promise results to partners. What I can and do promise is that. And here we come to the final rule. After 6 rules of telling his partners what he won't do and what he can't do, he finally tells them what he will do. This is his creed. This is his solemn vow. And it has 3 parts. Part A. Our investments will be chosen on the basis of value, not popularity. In other words, we are contrarians. We will buy what is cheap and unloved, not what is trendy and expensive. We will be greedy when others are fearful, and fearful when others are greedy. This is the very essence of value investing. He's promising to ignore the siren song of the crowd and stick to his own independent analysis. He's promising to buy businesses, not lottery tickets. Part B. That we will attempt to bring risk of permanent capital loss to an absolute minimum by obtaining a wide margin of safety in each commitment. This is the key to it all. The margin of safety. It's Ben Graham's most important concept. It means you don't just buy a good company. You buy it for significantly less than you think it's worth. You buy $1's worth of value for 50 cents. That discount, that margin of safety, is your protection against a future that is always uncertain. It protects you if you made a mistake in your analysis. It protects you if the company hits a rough patch. It's the shock absorbers on your car. Buffett is promising not just to try and make money, but to first and foremost try not to lose money. Rule number 1 of investing: don't lose money. Rule number 2, see rule number 1. That's what this is all about. And finally, part CC, my wife, children, and I will have virtually our entire net worth invested in the partnership. This, right here, is the ultimate promise. This is what separates the true partner from the hired hand. He's not just managing their money, he's managing his money. Right alongside theirs. He is eating his own cooking. His interests were not just aligned with his partner's. They were identical. If they lost money, he lost money. In fact, because he and his family had the largest single stake, he would lose more money than any of them. There was no heads I win, tails you lose situation here, which is so common in the financial industry. It was, we are all in this boat together. We will sink, or we will swim as one. Can you imagine if every financial advisor, every mutual fund manager, had to abide by that rule? If they had to have their entire net worth invested in the same funds they recommend to you? The world of finance would look very different, I can tell you that. So there you have it. The 7 ground rules. The foundational philosophy of a 25-year-old kid from Omaha who was about to take Wall Street by storm. They aren't complex formulas. There's no secret algorithm. It's a mindset. It's a philosophy built on realism, on patience, on discipline, and on an unshakable intellectual honesty. He promised to be honest about returns. He promised to be accountable for bad years. He promised to measure himself against the market, not his own ego. He promised to think in terms of years, not months. He promised to ignore the noise of prediction. And most of all, he promised to put his own skin in the game, to align his fate completely with those who trusted him. These rules are what allowed him to hunt for those 50% a year returns. He could swing for the fences on undervalued, forgotten little companies, because his entire operation was built on a bedrock of conservatism and long-term thinking. He had earned the right to be aggressive because his philosophy was so defensive. These principles are just as powerful today as they were in 1956. In fact, in our world of high-speed trading and meme stock manias, they are more important than ever. They are your shield against the madness of the crowd. They are your compass in a chaotic market. We've covered a lot of ground today, and this is just part 1. Next time, we'll dive deeper into the specific methods he used to find those incredible bargains. But for now, let these rules sink in. Think about how you can apply them to your own investing. Are you being honest with yourself about your returns? Are you measuring yourself against the right benchmark? Are you thinking in years or in days? Are you focused on the business, or are you distracted by the noise? And most importantly, are you eating your own cooking? Thanks for joining me here today. It's been a real pleasure. Until next time, stay patient, stay disciplined, and remember to think like an owner.